Hello and welcome to this Wednesday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, Mike Baudendistel is going to give us a rail intermodal update. But first, we're going to go to Zach Strickland with a carrier update brought to you by PowerFleet. Stay tuned.
Welcome to your Wednesday carrier update presented by PowerFleet. Welcome back, Anthony Smith, as well. So, looking at our tender rejection index for this Wednesday, we look at a 6.73 percentage rate for the rejection rate in the United States right now. We are up a good bit over yesterday. We still continue to climb. We anticipated this, especially as we're getting closer and closer to that July the 4th holiday period. But if you look year over year, we really didn't see the same thing happening just yet. It was still relatively soft. And this orange line right here, 2019, kind of a doldrum year for freight, if you will. 5.2% this time last year. So we are seeing elevated activity over last year, especially as carriers are a little bit less likely to cover some of that freight. But again, volumes are 6 to 7% higher this year versus last year. 2018, 24.07% tender rejection rate. We are nowhere close to that. But I do think that this looks a little bit more like what you would anticipate this time of year. This is a normal year. 2018 obviously was a little bit of an anomaly. 2019, I believe, was a little bit more of a softer side year, a lot less volatility in that year due to the oversupply situation. Now, looking at the rest of the United States and seeing where some of the capacity might be tightening a little bit more than other areas of the country, especially week over week, we've got our volatility map here. Anything in green basically tells you this is where some statistically significant changes in the tender rejection indexes are occurring in some of the markets, regardless of volume in the market. So some of these markets out here, Lubbock, for instance, McAllen, not your huge freight markets, but you have Dallas, Fort Worth sitting right there, Houston, all showing some moderate increases in tender rejection rate right now. So week over week, things have tightened a little bit more in those areas. You've got a few spotty markets out in the East Coast, but not very much going on right now. Right here in the middle of the country, right around the, again, some smaller markets, Omaha, Hutchinson, Kansas. Kansas City is a pretty decent sized market, all showing some decent increase in tender rejection rate, as well as out here in Arizona with Phoenix, which we covered on the brokerage update yesterday. Let's break down the Dallas market, because Dallas is probably the largest market represented in that green section there. So looking at the Dallas market, I've got the tender rejection rate here in the chart pulled up. You can see that those are spiking significantly. They are actually well above last year's rate by a good bit. If you pull up that chart, any Sonar user out there. And what's driving a lot of this is the difference between outbound volume and inbound volume. We're seeing an increasing amount of outbound freight in relation to inbound freight, therefore reducing the amount of available capacity in the market. So head haul index here in purple, if you follow this side of the chart here on the dual axis, you can see that the head haul index is showing a positive 81.52. What that means is that it's OTVI, outbound tender volume index, less the inbound tender volume index, and an 80, anything above a 50 is considered a very strong head haul market. So a market that has a lot more freight coming out than going in. Dallas is not your consummate head haul market, back haul market. It's more of just an even keeled market traditionally. So any dramatic changes in market balance are going to have an increased pressure, upward pressure on rates, therefore tightening capacity as well. So an 81, a very strong value, a lot of outbound freight, pushing all that capacity out of the market right now, driving up tender rejection rates. You can see that they're following each other pretty cleanly right now. This is what I would consider a seasonal pattern for the Dallas market this time of year, especially as things heat up. The tweener outbound tender rejection index taking one of the biggest hits, 8.2%. So anybody moving between 450 and 800 miles out of this market having some difficulty. Long haul as well, 7.82% coming out of the market. Wanted to break down real quick. Here's another example of truck stop rates. This is your all-in van rate per mile out of Dallas. Denver in the green, not going up as strong. However, going to Atlanta last week, rate jumped up significantly. So again, anybody going east out of Dallas needs to watch out for some tightening conditions. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hello and welcome to your Rail and Intermodal update. I'm here with Mike Baudendistel. Mike, what do you have for us today?
So this morning, the American Association of American Railroads reported the carloads for week 24. So, as we've seen, for most of the year, they're down, significantly year over year. We have seen on a sequential basis, though, some signs of improvement. They did bottom out right here in the beginning of June, sort of Memorial Day, but here still down 22.8% in the last year over year in the last week. Some of those categories have gone from being down, say, 80 or 90%, like motor vehicles was down at 90% at one point. Now it's down 50%. Still being hurt by coal being down, but a lot of the more sensitive commodities to the industrial economy, things like chemicals, metals, those things have been sort of flat at a low level. So it does show a lot of weakness in the industrial economy. Still, the quarter to date down 26%, but keep that down 22.8% in mind as we go to the next slide. This is intermodal units. So we see with intermodal units down a much more modest 8.5% in the last week for containers specifically. And this one you've also seen, not only did it not go down as far as rail carload volume, you've also seen it recover faster. So quarter to date down about 12%. As far as the railroads are concerned, carloads are more profitable than intermodal units. So, this is going to be a quarter where most of the railroads, if not all the railroads, do see their operating ratios, unfavorably increase, which has not been what we've been accustomed to. We've been accustomed to seeing them get, better, each year. But intermodal is one area where we are seeing, signs of recovery. If we break that down between domestic and international, which, really think of those as being two distinct markets. Here we have domestic in blue 2020 and green 2019. It's still down, close to 10%. But you actually see we're actually above where we have been at points prior in the year in COVID. It's sort of a stark contrast to international intermodal volume. International is still way below where it was, and you actually saw over the course of last year that decline as well, as there was more transloading from international containers into domestic containers. So. For those that are really primarily focused on truckload, the area that they want to focus in on is this domestic, volume that we have in Sonar. So the O-Rail DOM-L for domestic loads, that's really the one to focus in on, and that really reflects some of the strengthening that we've been seeing in the truckload industry as well.
Right, and we see this is a significant recovery trend that we have on the domestic side. On the previous charts, when we see that the rail or intermodal carloads right now starting to tick back up, do you think we found the trough there, or do you think there might be some still downward pressure in the coming weeks?
I think we're past the bottom. We'll see whether it's sustainable or not. I mean, I do think that there was a lot of goods that have been pulled out recently out of some of the warehousing centers, places like Ontario, California, to get them into stores that are reopening, businesses that are reopening. So you may be seeing somewhat of a surge just to replenish shelves and more local distribution centers. But I think we're past the bottom in that area.
And one of the things we see here was that this was already kind of weak last year. So really this is, would you say, has just been exacerbated by COVID-19 then?
Yeah, I mean, there's a couple of things going on there. I mean, I think, for one thing, there's plenty of containers. This was, and plenty of domestic containers. So this was one of the few years where none of the big domestic truckload-based providers, companies like J.B. Hunt, were taking delivery of any incremental equipment. And so really, there was a lot more transloading into those containers in order to utilize them. So really, you've had that trend combined with just the less demand this year.
Excellent. Mike, thank you so much. We appreciate it. And thank you so much for tuning in. That's going to do it for this edition of FreightWaves Now. But always tune in to our FreightWaves TV app on all your favorite streaming platforms like Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.